Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and this is a one-year daily candle chart of the Russell 2000 ETF, ticker symbol IWM. Last week, I drew some lines on the chart, and for those of you who have been following along, you'll know I leave the lines on the chart so you can see how the forecast worked out. Right here was Friday when the report went out last week, and I drew this line right there with the forecast target set at 219.16 for the Russell. And yesterday, on Thursday the 6th, we hit that precisely to the penny, formed a hammer pattern, and then bounced today with what is very close to a bullish engulfing pattern. Not quite, but very close. And if you look down at the bottom, you'll see the oscillators are starting to turn up. Now, there's two oscillators down here. We have the stochastics right here, and we have the CCI. Notice the wide divergence between the K line and the D line. The K line is the blue line, red line being the D line. And when you compare that to past divergences, you'll see that the market tends to rally when those wide divergences show up. That's number one. Number two, we are very close on the CCI right there as I magnify that, very close to crossing over this zero line, which is the momentum line. Now, usually we get 2 to 4 days of follow through in the direction of that cross. So if that crosses on Monday, and I think it will, then most likely we will see higher prices on IWM. So I'm just going to draw my forecast line just like that in a direction that resembles the angles back here. And I do believe that we will go up to test this resistance. So the target for IWM is going to be 230.74. Write that down and check back with me next week, and we'll see whether or not that target hits. Now, let's go right to the VIX, Volatility Index. It's an oscillating index. For the most part, it works inversely to the S&P. Left my lines on the chart here, and you can see I said we would bounce off that 20-period moving average. We did just that. Missed that target, not by much, but just missed that target. We had resistance back here. It pulled back, and now we have this big red candle. Let me erase these lines and explain to you what this means. A big red candle like that with hardly any shadows is by far a fairly bearish candle. However, we have a support level down here on the VIX below 16. I believe that the VIX will go down to test that support level and then bounce just like that. So for those who trade the VIX, you have a short-term opportunity to downside and then a new opportunity to get long at that support level. Keep an eye on the CCI, because when the CCI goes oversold, then starts to turn up from here and crosses this minus 100 mark there on the scale, then the VIX becomes more bullish, which in turn, remember, tells us that the S&P, being inversely related, will most likely start to drop as the VIX goes up. So again, keep that on your watch list. VIX is, in my opinion, one of the best leading indicators you have out there. And again, it tracks the S&P, which I'm going to right now. The S&P 500 ETF, known as the Spiders. We had a forecast, a long-term forecast line down here. It's not hit yet. I do believe it will be hit eventually, but here's what I'm going to do for you. I'm going to keep that 395 price target in mind, and I'm going to condense my price action here to give you the short-term forecast. So I think next week the S&P is going to go up. We'll have to keep an eye on this hinge right here. If the CCI starts going down, that means trail your stops up. So if you're doing a good job trailing your stops and following my risk management principles, then you would have done very well this week. Absolutely. Now what I'm going to do is I'm going to draw a price line right at 395. This 395 level down here is going to be my long-term target. So I'm just going to keep that. I'm not going to do it as an angle. I'm keeping that in place, and I'm going to keep tracking that. And the main reason for that is we have gaps down here that still need to be filled. Right? Gaps fill 80% of the time. If you're unfamiliar with what a gap is, it's basically a price void. See that? Between this high on this day and the low from the next day right here, there is no price action. So gaps fill 80% of the time. Then once they fill, there's an 80% chance that the price will bounce. Hence the reason why I think this will act as a longer term support level for the spiders. All right, so that's my forecast right there. Again, next week's target, putting a number on that as the data box pops open right there, is going to be 425 to the penny for the price target for the spiders next week. Now let's take a look at the Qs. Ticker symbol QQQ, representing the tech sector, right? I'm going to keep this long-term price target as well right here. That's that support level right there. See that? So that's going to stay in place, and we're going to erase this line here to clean it up just a little bit and clean this up just a little bit. Zoom in for you, and let's see what's happening with the Qs. A little bit different than the other markets, actually. Today, we filled this gap here. We filled that gap. There is resistance up here at the top, which I do believe the Qs are going to reach and turn back from. So here's the forecast. Next week, I think we're going to go up, test that resistance, and then pull back from resistance. So probably Tuesday, Wednesday, maybe into Thursday, looking at a price target of 341.35 on the Qs. If it starts trading over that moving average, great. Trail your stops, protect any profits, and defend against what I think is ultimately going to be one of the biggest pullbacks in decades. And I'll get to that in just a minute after we look at the diamonds. Ticker symbol DIA is the Dow Jones Industrial Average ETF. We came close to pulling back to my price target. Remember last week I said I believe that we would pull back a bit, and I said I don't think a collapse is in order, but I did say a pullback. We came close to that and then bounced. Now, again, different than the other markets. Let me zoom in here just a little bit more for you. We have 1, 2, 3, 4, 5, 6, 7 green candles in a row. 7 green candles in a row. And what does that mean? Well, that's known as a stale green light, and we're long overdue for a red candle. Now, the drop in volume today on this Friday the 7th is significant because it tells us that the sellers are losing momentum. So, I think we could open higher on the diamonds on Monday, but ultimately I think we are definitely going to pull back towards that moving average. So it's going to look something like this, a little bit higher, and then a pullback to this moving average by the end of the week. And the reason I say that is, again, the stale green light. Remember, 7 green candles in a row down here. We have a wide divergence from the moving average. That is known as the rubber band effect. We have the oscillators overbought in both cases, the stochastics and the CCI rolling over. That's bearish. And we have gaps below the market on the diamonds as well. Right, so we could see some significant pullback eventually in the market, but in the short term, we still see the money coming in. The buyers are still motivated, although I look at this market and I scratch my head wondering why. And maybe some of you are feeling that way as well. I want to show you some things that might be shocking, but it brings attention to the Fed. If you haven't seen it already, we're going through massive levels of inflation right now. And if you look at lumber prices alone, take a look at this. The price of lumber in just 1 month has risen to dramatic levels. These are the highest levels we've had in many years for lumber. And that's just lumber. So think about what that will affect in construction, new housing, even people that want to spend the money at Home Depot but now putting that sale off because they can't afford to put on the back porch for the summer. Whatever it may be. This is inflation in a severe level. And when you look at lumber and then go to iron, take a look at the iron market. Look at the Singapore Exchange. Look at what's happened in this short period of time where it's gone from 140 to 200, just under 200. In fact, as of today, it's over 200, and there's no sign of this slowing down. Now, think of the Fed. Why are they not yet raising rates? If they don't raise rates, then we will have out of control inflation. In fact, it might already be there. And when you think that's bad, take a look what's happening over at Ford. The chip shortage on top of this. The semiconductor shortage strikes again. This is a headline that came out recently. Look at this. It came out on May 4th. There are thousands upon thousands of Ford trucks sitting in Kentucky right now. And folks, if you know anything about an engine, these things need to be run. If they sit in a lot and collect humidity in the cylinder walls, they're going to rust up. Guess what? People are not going to want to buy trucks that have been sitting there for months. So they have an inventory problem right now, and they have a supply problem to boot with the semiconductors, and that's affecting every area of our lives. It's not just with trucks, it's with tractors, it's with jars for jelly. It goes on and on and on. So eventually, it's this fuse that I say has been lit. It's a short fuse, but eventually what's going to happen is we're going to see a correction. I can stake my reputation on that. It's not going to be tomorrow. It may not even be next week. It may even be not to the end of this month or beyond. But when you look at the IWM, and I keep showing this to people, this is a super overextended market. And on the monthly charts, look at the oscillators down here. Let's just zoom in for you. The oscillators are rolling over with sell signals, even though we're coming up to test these highs. You see, wide divergences from the moving average, drop in the volume, oscillators overbought and turning down. It doesn't get clearer than this with regard to technical signals. So again, trail your stops up. You could protect your profits, no doubt about that. I, for one, as an option trader, am putting out the word to our option members that there's going to be a lot of money to be made on the downside. So anyone who's a member of our Option Oracle services are going to do very well as the markets roll over. In fact, we have put spreads on. Again, I know I'm talking to some folks that don't know what an option is, but we have put spreads on that are actually making money on the way up because of the premium that we're collecting on some of these spreads. So as scary as it may seem with regard to the economic outlook, I'm excited for the opportunities that we have in the market. Please do everyone a favor, like and share this video. You could add some comments to the bottom. That's fine. I'll try to get to those and stay connected as we go through the markets each and every week. Have a great weekend, and we'll talk to you soon. So long.